How's it going, everyone? So today I want to spend a little bit of time going over what is increasing in popularity in the stock market, which are these covered call ETFs. With any investment, it's always important you understand what you're investing in. And I think a lot of people are getting dazzled by these returns that they may see online, which is great. And I encourage everyone to invest. But let's make sure you understand what's happening with your money when you invest in these types of funds specifically. So the first thing that we need to go over is briefly what a call option is. And a call option is just when you buy a call, you get an expiration date and a strike price. And you have until that expiration date to buy 100 shares per contract at that strike price. Your goal is that the stock is going to be significantly higher than the strike price so that you're making money basically from the start. For this option, you're going to pay a premium, right? So you're going to pay for the shares if you choose to exercise it, but you're also going to pay a premium to the person who writes that call. And that's where we get into the covered call piece. So a covered call is you have the shares and you write or sell that call option. You collect a premium. And if somebody chooses to exercise that option, you're going to transfer those shares over to that person. If the call expires worthless, so it gets to the expiration date, and it's under the strike price, you still get that premium as income. So it's become a very popular strategy for people to write covered calls because they own the underlying and just collect premiums as additional income. So when we talk about covered call ETFs, what exactly are they doing? Well, like we said just before, you need to have a position in a stock. So these covered call ETFs have a position in an underlying stock that they are looking to write covered calls against. When they write those covered calls, they are then able to generate income by collecting premiums from all of those covered calls. So someone comes in, they pay for the call, they expire worthless, premium goes into the portfolio for the ETF, rinse and repeat, and they can do this on a fairly large scale. So instead of you writing the covered calls for a couple of contracts, depending on how much you have, this is an ETF doing it at a larger scale and collecting income. Now, if the underlying stock appreciates, there's also potential for income to be made there. Because as stocks go up, you potentially can make money, but they would have to get out of that position, right, in order to get that money back. So the big thing with these is the payout. A lot of these funds are paying out monthly or even weekly for some of their funds. And what that does is generate regular income for you as an individual. So this means that you can get paid monthly, weekly on your investment. Things to be aware of, though, are you are going to see the price of the fund drop when the dividend gets taken out, right? So this is a normal cycle for these types of funds. Your buy-in number, the growth and all of that, those are not as important. Of course, you want to get the best deal you can, but they're just not as important as being aware of how this runs. So when they say that the price is, when the price of a stock is currently at $20, they announce a $2 dividend, it's going to drop to at least $18 when they pull that money out and pay out the shareholders. That's just the way these funds work. There is a normal cycle of that. The price will go up and down throughout the time to the next payout, but be aware that this is something that happens with all of these. And of course, with any investment, there's the good and the bad. So real easy, what are the benefits here? It's everything we've talked about. You have somebody else performing these covered call transactions for you. They're making money off of it, and then they're paying you out an income for the work just because you've invested in them. Now, there are things that they might have access to that let them know what good stocks to write these covered calls against are and things like that. But at the end of the day, it's just that somebody else is doing this work and you are collecting that premium because there's nothing that's stopping you from writing covered calls yourself. Now, for some of these, a share of a covered call stock may be significantly less than buying 100 shares of something, writing a call against it, and so on and so forth. So it may also be more accessible to you. But the big thing for you is once you find an underlying stock you like, that you don't have to go do the work. This ETF is going to do the work for you. There's always risks involved though, right? So if things start spiraling down, you're not going to get paid out as high of a dividend. Even when you do get paid a dividend, it's going to come out of the share price and the stock's going to keep going down. So that's why it's so important you understand what the underlying asset is that these calls are being written against. So the premiums collected do help negate a little bit of, the impact of drops. However, it can not be enough, or it might just be enough that you're breaking even and not really making it out ahead. So that income is more becoming just a break-even number for you. On the flip side, if a stock is taking off exponentially, you will probably not be able to capture all of the upside of that movement with a covered call ETF, certainly not compared to just being invested in the stock itself. But again, this is a strategy that's based around generating income. It is not a strategy that's based around holding stocks for growth. So keep that in mind. So let's just briefly wrap up here with everything we talked about. What is a covered call? A covered call is you selling a call when you have the shares to transfer over if someone chooses to exercise that call. You receive a premium for selling that call, and if the call expires worthless, you keep the shares and you keep the premium. Remember your risks. It's always important to know that with any investment there are risks. So understand what covered call strategies are and understand what the benefits are and what the goals of your investment are. Most of the time for these, again, people are looking to generate some sort of passive income. But know what you're investing in and understand that there is always a potential that you'll lose money. In general, these ETFs seem to be on the rise of popularity, which means you'll see more and more funds popping up. Like I said, make sure you understand the underlying stock. The way that they invest tends to not be too different across funds, but some are more effective than others, some pay out differently. So I do think that covered call ETFs are going to be increasing in number over time, but the quality of the covered call ETF that you choose to invest to will vary. So make sure you know what you're investing in, who you're investing with, and make sure that you're investing as smart as you can. Thanks for hanging out through this video, and I will see you in the next one.